We're here today to launch our May bi-monthly report, focusing on trends in all sectors of the Irish commercial real estate market over the last number of months and looking to what might happen over the summer months. We had a very active March and April in the Irish commercial property market, particularly in the investment space, with over 1 billion of investment transactions recorded in the first quarter, and quite a few portfolios and indeed individual assets being prepared for sale at the moment. Indeed, over the coming weeks, there's up to 500 million of Irish investment assets likely to be launched for sale. And in addition, we have visibility on up to 15 billion of face value loan portfolios which are due to come to market over the coming months. The latest data from MCSI, or the old IPD, is showing that Irish commercial property returned a total return of 4.3% in the first quarter, which is a very strong rate of growth. In addition to deleveraging activity, we continue to see increased evidence of secondary trading, with many of these transactions occurring off-market. We're also increasingly seeing single bid processes as opposed to the two-stage processes that had become part of the market over the last number of years. Single bid processes being much more attractive to the types of investors that are looking at assets in Ireland today. We continue to see new entrants to the market, and indeed many of the deals that were completed in the first quarter of the year were to new entrants, which is widening the investor pool in the Irish commercial property market. And we also continue to see new debt providers to this market, particularly for larger lot sizes, which is encouraging. Prime yields have stabilised in the market over recent months, which is encouraging. Most of the rental growth projections have already been built into pricing. So prime office yields in Dublin today are 4.75%. Prime high street retail is trending at approximately 4%, while prime industrial yields are in the order of 6.5%. Moving to the office occupier market, we had a very strong first quarter with indeed 64 individual leasing transactions totalling over 38,000 square metres completing in the period. And that was the highest quarter in terms of the number of transactions in over 7 years. So it suggests that there's quite a lot of activity, albeit many of the transactions in the last quarter were quite small. It also suggests that much of the shortages of Grade A accommodation that we've read so much about tend to be in the CBD, and in actual fact there is availability outside of the core Dublin 2-4 market, and increasingly we're seeing occupiers moving to more outlying locations of both the city and indeed into the suburbs, and we're also beginning to see rents growing in these suburbs. The largest letting to sign in Dublin in the first quarter to Parexel, a TMT company, happened in the Dublin 6-8 district, and 5 of the top 10 leasing transactions signed in the quarter occurred in the suburbs. Prime rents are currently in the order of €511 per square metre or €47 per square foot, and they're quickly heading towards €538 per square metre or €50 per square foot. Some occupiers are now beginning to sublet and assign excess accommodation to cater for many of the occupiers that are in the market for accommodation now. There's quite a lot of planning applications being lodged and a lot of new stock being discussed, but the reality is this will not come into the market until at least 2017. So in the interim, we're likely to see more discussion around potential refurbishment projects. We also saw continued activity in the industrial sector in the first quarter with a bumper Q1, 86,000 square metres of lettings and sales completed in this particular sector. But as the supply of modern industrial stock continues to dwindle, it will be difficult to maintain such healthy levels of take-up over the coming quarters. Industrial rents have started to rise. They're currently in the order of €70 per square metre and are likely to hit €75 per square metre during the calendar year. But they're not quite at a level yet which would justify new development. Having said that, we're beginning to see quite a bit of appetite from developers for good and well-located industrial sites to cater for the next phase of development in this particular sector. Many of the facilities that have sold in the industrial sector over recent times have been for alternative use. We've also seen some investment sales, albeit quite small transactions, because sourcing industrial investment opportunities still remains quite challenging. There has been a considerable improvement in the retail sector over recent time. There's been momentum building in shopping centres, retail parks and high streets right around the country, most of whom are now boasting negligible vacancy rates. And indeed, looking at some of the high streets in various towns around the country, we have seen quite a few improvements over the last couple of months. As competition for the best pitches escalates, we will continue to see rental pressures, and we will see rental growth in regional locations, not just Dublin, over the coming while. The new owners of many of the retail parks and shopping centres that have emerged over recent years are now beginning to make their presence felt, with very aggressive asset management strategies now starting to manifest themselves, and that in turn is giving rise to some opportunities for many of the occupiers that are out in the market looking for premises today, with very strong appetite from fashion retailers in particular, and also many Irish and international cafe and restaurant chains, some of whom may end up paying a premium to find premises over the next while. There's quite a lot of appetite in the development land sector, but other than two very large sites which came onto the market recently, namely the Millennium Scheme in Naas, which is guiding 35 million, and the Project Trinity scheme in Ballsbridge, which is guiding in excess of 120 million, most of what's on the market tend to be quite small infill development sites. And indeed, in the first quarter of this year, there were only 17 such transactions, totalling 72 million between them. There is a severe shortage of residential zoned land on the market, particularly large lot sizes and particularly in Dublin. We are seeing quite a lot of appetite for alternative uses as well, with many of the purchasers of development land at the moment not just looking for office and residential sites, but equally looking for opportunities in the student housing, hotel and nursing home space. There has been much speculation over recent times about possible government intervention to relax building standards in Dublin, which are making development in many cases unfeasible. Any improvement in this space to improve the viability of development would be much welcomed. The hotel space is another sector where there's been considerable volume of activity over recent times. Indeed, in the first quarter, more than 500 million of transactions signed in the Irish market, which was higher than the entire year last year. 25 hotels changed hands in the first 3 months of the year in 17 individual transactions, including the Irish assets within 2 particular portfolios. Negotiations are currently concluding on another portfolio sale, Project Crystal, where 7 assets are being sold individually, the Maldron in Wexford, the first one having already sold out of that particular portfolios. Hotels right throughout the country are reporting improved trading performance, and we're seeing quite a lot of appetite right around the country. And indeed, there are up to 60 hotels likely to come available for sale through individual asset sales and portfolio sales over the coming weeks and months. RevPAR in Dublin is up 9.9% year on year, while average room rates are up 6.9% according to the latest stats from Hotstats. We also continue to see quite a lot of pubs being brought to the market, although it is taking quite some time for these transactions to conclude. Only 2 pub sales completed in Q1, although there are quite a number of assets in the pipeline and due to complete over the coming weeks and months. So in summary, it has been a very active number of months. Pricing has stabilised to some extent because yields have already built in the rental growth prospects that are likely over the next while. There will be a huge amount of assets coming to the market over the coming weeks and months, both in terms of individual asset sales and indeed portfolios, as the next wave of deleveraging kicks off, coupled with continued secondary trading, much of which is happening off market. So it would appear that a very busy summer season is in prospect in the Irish commercial property market.